Imagine this. You walk into a store and see two identical TVs. One costs $500. The other costs $1,000. Which one would you buy? The $500 one, right? That's obvious. But here's the crazy part. When it comes to stocks, most people do the exact opposite. They buy the expensive one and avoid the cheap one. Today, I'm going to show you exactly how to spot when a stock is cheap or expensive. This isn't some complicated Wall Street secret. It's actually pretty simple once you know what to look for. And by the end of this video, you'll never look at stock prices the same way again. Here's what most people get wrong about stock investing. They think a $10 stock is cheaper than a $100 stock. That's like saying a slice of pizza is cheaper than a whole pizza without knowing how big each slice is. The price alone tells you nothing. Let me give you a real example. Right now, Centene Corp trades at around $60 per share. Tesla trades at around $240 per share. Most people would think Tesla is more expensive. But here's the shocking truth. Centene is actually trading at a price-to-earnings ratio of just 4.34. Tesla's ratio is over 60. That means you're paying 60 times Tesla's earnings for each share, but only 4.34 times Centene's earnings. This confusion costs investors thousands of dollars every year. They buy overpriced stocks thinking they're getting a deal. They avoid undervalued gems because the share price looks high. It's like shopping for groceries without looking at the price per pound. So, how do you actually tell if a stock is cheap or expensive? Professional investors use something called valuation metrics. Think of these as price tags that show you the real cost of what you're buying. The most important metric is the price-to-earnings ratio, or PE ratio. This tells you how much you're paying for each dollar of the company's profits. It's like asking, how many years would it take for this company to earn back what I paid for my shares? Here's how it works. Take the stock price and divide it by the earnings per share. If a stock costs $50 and the company earns $5 per share, the PE ratio is 10. That means you're paying 10 times the annual earnings. But here's where it gets interesting. A low PE ratio usually means the stock is cheap. A high PE ratio usually means it's expensive. But there are exceptions, and I'll show you exactly when to break this rule. Let's start with the price-to-earnings ratio. This is your bread and butter metric. Most professional investors look at this first. A price-to-earnings ratio under 15 is generally considered reasonable. Under 10 is often a bargain. Over 25 starts getting expensive. But here's the catch. You need to compare apples to apples. A tech company might have a PE of 30 and still be cheap compared to other tech companies. A utility company with a price-to-earnings ratio of 20 might be expensive for that industry. Look at the current market. General Motors has a PE of just 7.66. That's incredibly low. Meanwhile, many tech stocks have PE ratios over 50. This doesn't automatically make GM a better buy. It just means you're paying very different prices for each dollar of earnings. Now, there's a problem with basic PE ratios. They only look backward. They tell you what the company earned last year, not what it might earn next year. That's where the PEG ratio comes in. The PEG ratio takes the PE ratio and divides it by the expected growth rate. This gives you a much better picture. A stock with a PE of 20 might seem expensive, but if it's growing at 30% per year, the PEG ratio is 0.67. That's actually quite cheap. Here's the rule. A PEG ratio under 1.0 is generally considered undervalued. Over 2.0 is getting expensive. Walmart, for example, has a PEG ratio of about 2.97. That suggests it might be overpriced relative to its growth prospects. But wait, there's more. Sometimes companies don't have earnings at all. Maybe they're losing money while they grow. That's where the price-to-sales ratio helps. This compares the stock price to the company's revenue instead of profits. Amazon is a perfect example. For years, it had little to no profit because it reinvested everything into growth. But its price-to-sales ratio showed whether investors were paying a reasonable price for that growth. Today, Amazon's price-to-sales ratio is about 3.11, which is actually reasonable for a company of its size and growth rate. Then there's the price-to-book ratio. This compares the stock price to the company's book value. Book value is basically what the company would be worth if you sold all its assets and paid off all its debts. This metric works greatly for banks and other asset-heavy businesses. It's less useful for tech companies that don't own much physical stuff. Let me show you how this works in the real world. Right now, the market is giving us some fascinating examples. Centene Corp has a PE ratio of just 4.34. That's incredibly low. It means you're only paying about 4 years' worth of earnings for each share. Compare that to the overall market, where the average PA is around 25. This suggests Centene might be a bargain. But hold on, before you rush to buy it, you need to ask why it's so cheap. Sometimes stocks are cheap for good reasons. Maybe the business is declining. Maybe there are regulatory problems. Maybe investors expect earnings to fall. This is what professionals call a value trap. On the flip side, look at Tesla. Its PE ratio is over 60. That means you're paying 60 years' worth of current earnings for each share. Most people would call this expensive, and they might be right. But Tesla bulls argue the company is growing so fast that today's earnings don't matter. They're betting on massive future growth. Here's another example. Delta Airlines has a PE of 8.19. That seems cheap, but airlines are cyclical businesses. Their earnings go up and down with the economy. A low PE might just mean we're at the peak of the cycle. The key is context. You can't just look at one number. You need to understand the business, the industry, and the economic cycle. Professional analysts at Morningstar use a more sophisticated approach. They calculate what they think each stock is really worth. Then they compare that to the current price. They use a star rating system. 5 stars means the stock is very undervalued. 1 star means it's very overvalued. But here's the interesting part. The margin of safety they require depends on how uncertain the future is. For a stable utility company, they might buy at a 20% discount to fair value. For a risky biotech company, they might want a 75% discount. This makes perfect sense. If you're not sure what something is worth, you want a bigger safety margin. It's like buying a used car. If you're not sure about its condition, you want a really good price. Now let me tell you about the biggest mistakes investors usually do. First one is focusing only on the stock price. A $5 stock is not automatically cheaper than a $500 stock. What matters is what you get for your money. The second mistake is ignoring the business fundamentals. A low PI ratio means nothing if the company is going bankrupt. You need to understand why the stock is cheap. Is it a temporary problem or a permanent decline? The third mistake is not comparing to peers. A PE of 15 might be cheap for a tech stock but expensive for a utility. Always compare companies to others in the same industry. The fourth mistake is timing. Even if a stock is cheap, it can get cheaper. Even if it's expensive, it can get more expensive. The market can stay irrational longer than you can stay solvent, as the famous saying goes. Here's a perfect example. In early 2010, Tesla went public at $17 per share. 9 months later, it was trading at just $4. By any measure, it looked cheap. The company was losing money, but it had revolutionary technology and huge potential. Investors who bought at $4 and held on made fortunes. But plenty of investors bought at $17, watched it fall to $4, and sold at loss. The lesson is that even when you're right about valuation, timing matters. That's why professionals often buy in stages rather than all at once. Here are some advanced techniques the pros use. First, they look at multiple metrics together. They don't rely on just PE ratios. They combine PE, PEG, price to sales, price to book, and other measures to get a complete picture. Second, they adjust for the economic cycle. A cyclical stock might look expensive at the bottom of the cycle and cheap at the top. You need to think about where we are in the cycle. Third, they consider the quality of the business. A high-quality company with a strong competitive advantage can justify a higher valuation. A commodity business with no competitive edge should trade at a discount. Fourth, they think about catalysts. What might cause the market to recognize the stock's true value? Maybe it's a new product launch, a management change, or an industry recovery. Without a catalyst, cheap stocks can stay cheap for years. Fifth, they manage position size based on conviction. If they're very confident in their analysis, they might make it a larger position. If there's more uncertainty, they keep it smaller. Here's something most people don't know. Professional money managers often have different time horizons than individual investors. They might be willing to wait 3 to 5 years for a stock to reach fair value. Individual investors often want results in 3 to 5 months. Right now, the overall market is expensive by historical standards. The S&P 500 is overvalued by somewhere between 104% and 173%, depending on which metric you use. That means finding bargains is harder than usual. But there are still opportunities if you know where to look. Energy stocks like APA Corporation and Devon Energy have very low PE ratios. Utility stocks like Edison International are also cheap. Traditional retailers like Comcast are trading at reasonable valuations. On the expensive side, many tech stocks are trading at very high multiples. Some of this might be justified by growth prospects, but some of it is probably just market euphoria. The key is to be selective. In an expensive market, you need to be extra careful about what you pay. You also need to be patient. Good opportunities might be rare, but they do exist. Here's what you should be watching for. Look for quality companies that have been dragged down by sector weakness rather than company-specific problems. Also, keep an eye on emerging industries that haven't gone mainstream yet. These can offer strong long-term value if you're willing to be patient. So how do you put this into practice? Start by using a stock screener. Most brokers offer these for free. You can screen for stocks with low PE ratios, low PEG ratios, or other criteria. But don't stop there. Once you find potential candidates, dig deeper. Read the annual report. Understand the business model. Look at the competitive landscape. Check the management team's track record. Start with a process. Screen for stocks that meet basic criteria: low PE, reasonable debt levels, and positive cash flow. Then research each company one by one. Try to understand why the stock looks cheap and whether that might change. Set position limits. No single stock should make up more than 10% of your portfolio. This helps protect you in case you're wrong about a company. Diversification matters. Think about time horizon. Value investing takes patience. You might be right about a stock's value, but wrong about the timing. Be ready to wait. Remember, the goal isn't to find the cheapest stocks. It's to find stocks trading below their true value. Sometimes that means paying a fair price for a great business, instead of a cheap price for a weak one. Here's the bottom line. Determining whether a stock is cheap or expensive isn't about the share price. It's about what you get for your money. Use valuation metrics like PE ratios, PEG ratios, and price to sales ratios to get the real picture. But remember, no single metric tells the whole story. You need to understand the business, the industry, and the economic context. You need to think about quality, growth prospects, and potential catalysts. Most importantly, you need patience. Great investments often take time to pay off, but when they do, the rewards can be substantial. The market will always give you opportunities. Sometimes stocks will be obviously cheap. Sometimes they'll be obviously expensive. Your job is to recognize the difference and act accordingly. If you found this helpful, make sure to subscribe to the channel for more practical investing advice. Hit that like button if this changed how you think about stock valuation. Share this video with someone who needs to hear it. And leave a comment below telling me which valuation metric you find most useful. Remember, building wealth isn't about getting rich quickly. It's about making smart decisions consistently over time. Understanding valuation is one of the most important skills you can develop as an investor.